What's up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of Amazon. Post earnings, you've seen the stock rally significantly, but shares have come down from that high, which I do personally believe offers a good entry point for new money. But as always, this video is not investment or financial advice and is solely for entertainment purposes. So let's dive right in here to the past 1 year price performance of shares of Amazon relative to the benchmark. You can see that within that time frame, shares have underperformed the benchmark by 3.1%. On a year-to-date basis, shares are relatively in line, only outperforming the benchmark by 0.1% and are still trading below their 52-week highs. You can see in that top graph there, really post earnings towards the end of July, you can see a vertical line up in shares of Amazon, trading now above both their 50-day moving averages in the green line and 200-day moving average in the orange line. You can see really since the end of 2025, the 50-day moving average in the green has crossed over the 200-day moving average in the orange, which does indicate a positive buy signal, and shares are trading healthily above both those averages, which does indicate, at least in the short term, when a technical pattern, shares still offer a very attractive buy. When we look at a few key items here, I want to start with the earnings per share that you can see at the bottom left. You can see in 2026, earnings per share going from $12.64 to $10.61. Now, there's a variety of reasons as to why that is occurring. One is an accounting reversal of a one-time investment gain on its multi-billion-dollar stake in Anthropic. Another reason is the excessive CapEx, $220 billion as of the most recent quarter, projected to be spent by Amazon. And with all that CapEx in data centers and custom silicon, and even satellite communications to compete with Starlink, the older machinery is subject to depreciation and amortization. So Amazon is not new to these accounting practices, but that is one of the few reasons why we are seeing earnings per share go down through 2027 and more of a normalization in their earnings per share growth. Yet when we look at the underlying fundamentals, you are seeing sales more than double the industry at 15.8% growth over the past year. If you look at these profitability metrics, gross margins at 51%, going to net margins of 17.4% is very remarkable. Now, Amazon is a multitude of businesses, and one of the arguments you hear in the market quite often is Amazon needing to spin off its retail business, which is a very low margin business, yet still makes up a large percentage of Amazon's bottom line. We'll touch on that later on in the video, but even with these low margin businesses making up almost 40% of earnings, gross margins are still up 51%, outpacing the industry and benchmark averages, even on a net margin basis, EBITDA margin basis. And look at that return on equity, even with the significant CapEx. And we've explored other companies in other videos, which I do encourage you guys to go take a look at. Those returns on equity are much lower, yet Amazon is one of the biggest spenders in the world for AI and data center buildouts. And so having those almost 31% return on equity is quite remarkable. And when we look at those valuation metrics at the top right, a trailing PE of 20.8, a forward PE of 22.8 is such value for the amazing suite of products and companies that Amazon owns. And you can see that in the top left. Yet when we look at the price of sales at 3.6, not much of a premium, especially relative to other names that we've seen in the double digits for a much better quality business. And analysts agree with that as well. There are 62 analysts who cover Amazon with an average price target of $329.63, which implies on average of these 62 target prices, shares appreciating almost 30% as of time of this recording. The biggest bear on the street has shares going down to $230, which is only an 11% drop, and the biggest bull having shares appreciate by almost 57%. The risk reward, I believe, is very much positive for investors. And we can even see in that top graph there, the yellow and especially the red bars have essentially disappeared, indicating not too many hold ratings on Amazon, and most certainly very few sell ratings on the name, which we should see a closure of that blue line to that dotted line, which is the analyst target prices, really close through share appreciation. And I want to mention, even post earnings, this is accounting for a lot of these analysts revising upwards their price targets. Even the biggest bear had to increase their price target on Amazon to $230. So it's a very healthy sign to see post earnings that the institutional money, the quote unquote smart money, believes that the true value of Amazon post earnings should continue to grow with the amazing quarter that was reported by Amazon. We will touch on that later on in the video. Now, I did want to include this valuation summary here. Amazon, like I mentioned earlier, has a history of accounting practices that have really skewed their earnings and reports. But just to put that into perspective, 5-year low right now on the forward PE of Amazon is 22.7, currently at 22.8. So it is trading at its 5-year low in terms of forward price earnings, and even price to sales, 5-year average of 3.2, currently at 3.6, like I mentioned earlier. Not that expensive for a great quality business. And we can see the quality of that business and the many businesses under the Amazon umbrella really growing over time. Look at these 10-year compounded annual growth rate numbers. Revenues increasing 21% on a 10-year CAGR. Operating income, 5-year CAGR of 30%, 10-year CAGR of almost 43%. We look at that net income on a 10-year compounded annual growth rate of 62.7%. And even our earnings per share on a recurring and diluted basis, 5-year averages close to 30% on a compounded annual growth rate. 10-year CAGR on earnings per share north of 60%. Quite remarkable and continuing to grow. And this is a company that's been around for quite some time and is said to now grow into its valuation. So let's see what the future has in store and if these numbers can continue to run. I personally believe they do. The market believes it, and so does management. So let's see in the next reports. And not only are you generating lots of revenue from a company standpoint, in terms of profitability, you're running a very, first off, operationally efficient business. You can see at the bottom there, revenue and net income per employee rising over the course of the past 5 and 10 years. That does indicate that the investments that the company is making, and you can see those returns on investment capital, total capital, equity, and assets, are being allocated correctly to improve operational efficiencies, and you're seeing those returns on those investments as shareholders and as management you like to see. And on top of it all, like I mentioned earlier, gross margins, operating margins, pre-tax margins, and net margins continuing to trend in the right direction over the past 5 and 10 years. And this is including the very low margin retail business that Amazon operates in. So to have these profitability metrics continuing to trend in the right direction at the scale and size that Amazon is at is quite remarkable. And with all that cash, really management has been very disciplined, having very good liquidity ratios and interest coverage, even after issuing quite a bit of debt, not equity, which is what we want to see as shareholders. They have been able to cover these interest charges and debt issuances. And as shareholders, we should feel confident in management's ability to allocate that capital efficiency. And you can see that in those returns on invested capital and total capital, like I mentioned earlier, continuing to rise. And I think this is a very important graphic, really to demonstrate how Amazon uses its cash and visually to see how much cash it truly has on its balance sheet. Just look at that bar chart there as of year end 2025. The $123 plus billion of cash and short-term investments. Compare that to the debt servicing charge as of year end there. Yes, that has risen, especially earlier on in the first 2 quarters of this year. Amazon did have large bond issuances, yet nothing major for investors to worry about. Amazon is a cash flow juggernaut and has the adequate capital to cover their interest charges. I also want to mention something that was mentioned to me back in 2022, the share repurchases that Amazon's management executed on. The market, for some reason, believes Amazon will do the same this year. I personally don't believe so, especially with the $220 billion of CapEx that is forecasted by Amazon's management to spend on AI and data centers. I'd rather see them pay down that debt or use cash to finance this growth rather than, obviously, first off, issuing equity, but also repurchasing shares as well. I believe that is a 2028 story, not even a 2027 story, when we see a lot of this realization of these investments, hopefully by then. And this is what I've been talking about here, where Amazon generates its cash. 35% of the sales still come from online stores, and another 23% come from third-party seller services. So that retail segment is still quite a large portion of Amazon's revenue. What we like to see is Amazon Web Services making up 21% as of year end sales for Amazon. And that is going to be the highest growing segment, projected by management at 35.5% growth year over year. The ad business as well, continuing to grow at a 17.5% year over year growth as of year end. I'll touch on the most recent quarterly numbers later on in this video, but we can see those 3-year trends really going in the right direction. And in that top graph, those green dots are the growth year over year visually for us to see. And you can see that purple bar, which is the third bar, Amazon Web Services having the highest growth, and the yellow right next to that having the second highest growth, is very high margin cloud businesses and ad businesses. As a shareholder, I'm very confident in holding shares as management is executing on the growth of higher margin segments. And my last point here before I touch on the most recent quarterly report is the breakdown of Amazon's revenue geographically. Yes, a lot of their revenue comes from the US, but that decline we're seeing on a 3-year trend basis coincides with the bigger AI spend, but also the bigger cloud spend we've seen globally, and AWS starting to work with a lot of the major European companies and Asian companies. So AWS expanding geographically means those regions are starting to make up a larger portion of revenue, seeing that higher growth, and you're seeing a more saturated market in the US with AWS taking care of over a third of cloud services for Fortune 500 companies. But now I want to touch on the Q2 quarterly report that was released towards the end of July, which caused an almost 14% spike in shares of Amazon in one day. I'll start with the AWS acceleration and cloud dominance. AWS alone posted revenue of $42.2 billion, a 37% year over year increase, significantly outperforming Wall Street's expectations, which was around 31%. This represented AWS's fastest growth rate in over 4 years. Not only that, AWS generated $11.2 billion in quarterly operating profit, maintaining a robust operating margin of almost 37% and supplying the majority of Amazon's total operating profit. Also in this report, we have seen proof of the AI monetization. CEO Andy Jassy highlighted that Amazon's custom AI chips, such as Trainium 2 and dedicated AI services, reached individual annual run rates exceeding $25 billion. I did touch on Amazon in a previous video a few months back, especially after that Andy Jassy letter to shareholders, where one of those points was the annual run rate if Amazon operated at full capacity would be $50 billion for the Trainium 2 chips, which is, if we're doing a comparison, equal to the size of AMD's run rate. Quite remarkable, but as of the Q2 report, that annual run rate is just over $25 billion. And I've been mentioning the big CapEx spend, the $220 billion of CapEx spend that Amazon has promised to the market, has caused a lot of concern for shareholders. But those fears were eased after management demonstrated that enterprise demand for cloud computing capacity, boosted by partnerships like Anthropic, still exceeded current available supply. This did provide investors peace of mind that management is allocating capital efficiently, like we saw earlier on in the video. And finally, which is a major reason long term a company's stock appreciates, is top and bottom line beats. Amazon reported an EPS of $5.75, crushing consensus, while total revenue finally surpassed $200 billion for the quarter. That is up 19.6% year over year. Strong operational cash flow generation reassured investors that Amazon can fully fund its expanded $220 billion of annual CapEx forecast without diluting balance sheet strength or shareholders. I appreciate you all for making it to the end of the video. Please do hit that subscribe button. Again, this is not investment or financial advice, it's just my own personal opinions, but stay tuned for the next video.